Hey investors, super excited for this video on how I made $265,000 with just one property. In this video, we're going to discuss a property we just went full cycle on, and we're going to talk about how we made the $265,000 on that one property, not 100 units, but one property, all the numbers that were involved. So reno, rents, purchase price, sales price. We'll show you a bunch of screenshots, the listing, so you can see it all. We're going to talk about my favorite and, in my opinion, the easiest strategy in real estate investing and creating wealth. We're going to talk about all the learning lessons throughout there. I'm going to show you some walkthroughs of the property, and we're just going to really take a deep dive here on this property so you can learn how to create wealth in the most simplistic strategy I think there is. So if this is your first time to the channel, I'm Dave Hathaway. On this channel, we discuss real estate, investing, and building wealth. So welcome. So the property that I'm going to discuss today is 15156 Wentwood Avenue, Woodbridge, Virginia, 22191. And here is what the listing looked like when we purchased the property. And so this property was listed back in 2013 as a bank foreclosure. I purchased it just off the MLS. It was listed for $144,000, which, yes, that sounds super cheap today, but that was the market rate back then. I didn't think I was getting like the most amazing deal, but the numbers really worked on this one. So purchased it for $144,000 again in 2013, as you see. And this was purchased actually in my own name. So not even in an LLC, which I would not advise anybody to do. I would never do it now. But back in 2013, I didn't know any better. So I purchased it in my own name, and I purchased it with a conventional loan with a 20% down payment, or about $30,000. And the rate back then, I think, was somewhere around 6%, if I can remember right. And we did a $30,000 renovation on the property. So we were all in at about $174,000 on this property. So our monthly expenses on this property were the $878 mortgage and the $75 HOA fee that we had to pay monthly. And so that came out to $950 of monthly expenses. Now we had a $30K down payment and $30,000 in renovations. So somewhere around $60,000. We were all in on this property, and we rented that property out for $1,595. And so with the $1,595 minus our monthly expenses of $950, we cash flowed each month about $645 of monthly cash flow. So that's how much we made each month in rent. Now that doesn't account for vacancy and repairs, but it gets complicated when you really dig into all those different things. So we're just going to go with the round numbers for now. Now, if you do not have a deal analyzer, I have a free one. If you go down in the description, you click on the link for the deal analyzer. You can download it for free. It's the one that I actually use today, and it makes things way more simplistic. So if you don't have a deal analyzer, go download that today. And it's going to save you time and effort when you're analyzing the numbers. So you can find deals like this on the MLS. They don't always have to be off-market deals. Now, we really dig into those numbers. The $1,595 in rent and the $950 in monthly expenses, again, gave us $645 a month in cash flow. But then if you break that down even further, it's $7,740 per year in cash flow. Now, I was unfamiliar about DSCR loans, which is debt service coverage ratio loans. Back in the day, I don't even know if they existed back in 2013. That might be a newer product to these markets. So I didn't refinance out into a DSCR loan. I kept it as a conventional loan. But some things that happened over that next 11 years of owning the property was that I actually didn't calculate how much rents were going to go up and increase. And so that wasn't in my equation. So my cash flow number at 645 was just for hey, rents stay the same, everything stays the same. But as you know, or if you don't know, rents have increased a significant amount over the last 5 years. Extremely amount during COVID and over the last 3 years. But rents increased. We increased our rents from $15.95, $100 up to $16.95 in 2019. And then in 2021, increased them again up to $18.25. And so I tell people that I don't think you should calculate rent increases in the future, but it is icing on the cake. So if you have a good deal already, this makes a good deal like an amazing deal if you have rent appreciation. And you really have to look and think about, is this a great market? Is this a growing market? So my advice to myself, to you, is re-look at rents and compare them to market rents annually or when tenants move out, preferably both. And this is why. So you notice that I told you we bumped our rents up, and that was every time a tenant moved out, we bumped our rents up. We actually didn't bump it up in the Middle East. We might have bumped it up in the Middle East once. When the tenant moved out, we re-looked at market rent and said, wow, rents have gone up a significant amount. I need to raise rents. But when we went to sell this property in September 2024, when I looked at market rents, they were at $2,400 and we were at $1,825. So I was so far below with this tenant. They must have been super happy living in the property because they were trying to sign a longer lease. And so we were losing out on $600 a month in cash flow, even though we were already cash flowing on the property. Now, insurance and HOA, sure, they go up over time. And I think HOA ended up at like $83 compared to the $75 that it started over those 11 years. Sometimes they go up higher. It depends on the HOA. Insurance has gone up, only has recently significantly gone up. But 2 years and all prior, insurance was kind of the same the entire time. And so a lot of times your rent will increase, but the expenses don't increase in equal amount. So if you're in a really good location that's growing, your cash flow is going to continue to increase and allow you opportunities to either refinance with appreciation or just have more monthly cash flow. So that's something I didn't actually anticipate when I was analyzing the property the first time. So I didn't know I was going to make as much money as I did. And so the key takeaway is buy right. So use the analyzer that we talked about, and also use my favorite real estate metric that most people don't talk about. That's time. So I wanted you to wait for that one. It's time. It's over those 11 years, rents increased, property valuations increased. And so that's what created the most amount of wealth. So use those to your benefit. When you're flipping properties instead of buying and holding rentals, you're paying a higher tax rate. You're paying short-term capital gains instead of long-term capital gains. So it's not advantageous to do that. It's advantageous to hold rentals for a long period of time and then sell them. So I call it the super slow flip. I think it builds wealth the easiest, the best. You still get all the equity buildup and you get all the extra benefits, including the lower tax rate for long-term capital gains compared to your income. You get the depreciation over the time that you're having cash flow or rental income as you hold that rental property. So you get all these extra benefits for holding the property long-term. That's why I'm a big fan of buy and holds. So that is not all. Why we held this property. In 2018, I did a refinance with the bank and I refinanced a loan. I think it was like $174,000. Basically pulled all my money from the down payment, from the renovation out of the property and got a 30-year fixed at a 4.75% interest rate. So interest rates went down, got a better interest rate, and our HOA, our mortgage was then $1,274 and our HOA was $80. Our rents went up to $1,825 at that time. So our monthly expenses were $1,350, rents were $1,825. So our cash flow was about $475 a month. Or if you're talking about a year, it was about $5,700 a year. But that also means that because we did the refinance, we didn't really have any money in the deal. So this is where you talk about infinite returns, where people calculate return on investment. Well, if I put $10,000 or $20,000 down for this rental property, how much am I going to make each month on that $10,000 or $20,000? Almost like an interest rate. When you pull all your money, so you have zero money in the deal, and let's say you make $475 a month, you're making $475 a month on $0 because you don't have any money tied into the property. And so you have an infinite return. It's infinity. And so those are the most amazing deals. You don't get that every single time with the rental property. So when people say, well, I want to pull all of my money out every single time, it doesn't always happen like that. If you're really being diligent with your numbers, making sure you're buying right, you can buy properties like this. This is not like a 1 in a million property. This was a pretty good deal. We held it for a long time. It was in a good location. Everything went right. It was very easy. So I want to talk about my favorite wealth building strategy here. You've heard of it before, and it's the BRRRR strategy. So it's the buy, rehab, rent, refinance, repeat. We have a video if you want to check it out. I'll put a link in the description if you want to get a deep dive on the BRRRR strategy. But it's basically exactly what we're talking about with this property. We rented it out. We refinanced, we took that money, we put it in another property, and basically you're recycling the same money over and over and over again in different rental properties. And so that's why it's so powerful. If you pull out all of your money, you start to get infinite returns. But even if you pull out a portion of your money and you're leveraging it, your return on investment usually goes up if you're buying right. And so that's why I think the BRRRR strategy or this method is literally the easiest method to create massive wealth in real estate. And a lot of times when you go to these real estate meetups and you hear people talk about their size portfolio, you start to go, man, they are way ahead of me in the game. They've got 10 properties. They've got 14 properties. And the amount of doors or the amount of units that somebody has does not correlate to the amount of wealth that they're building. And so the best strategy is have the least amount of units and gaining the most amount or most efficient amount of wealth with that amount of units. If you can meet your goals or exceed your goals with 1 unit, great. Get 1 unit. You shouldn't have 100 units. If you're doing the same amount of work and same amount of effort and same amount of wealth building with 100 units, then you're doing it wrong. And so a lot of times we compare units, or we think that units is the level of success, where I think it is net operating income per property. So if you're running an efficient business, this is how you know you're doing it right. And so that was a long way of saying, throw out the unit count. Don't worry if somebody says they have 20, they have 30, they have 100, they have 400 unit properties. It does not matter. Just select good ones. You don't need a ton to be successful and to build wealth for your family. So that's the takeaway that I want you to get. Now, in the 11 years that we had this property, we had 3 total tenants. And so there wasn't a ton of turnover. There wasn't a ton of stuff. When we rehabbed the property the first time, we did a major rehab. We didn't replace kitchens. We didn't replace bathrooms. Over those 11 years, we did it 1 time. That was the only time we did it. I think in 1 turnover, we had to replace carpets. And right before listing it, we did a little upgrade with flooring throughout. But overall, if you renovate the property good, you don't have to have this money suck that you're constantly putting money into. This is another huge takeaway, which is do the renovation right the first time. Use products that last a really long time. Don't just think about, hey, this is the cheapest product, because if you have to continue to replace things, you actually lose in the long run. So I've actually created a course on mastering the rehab. I call it Master the Rehab 101. I just released it. So this is the link to the course, or you can go down the description, click on the link, and it shows you how to do these rehabs the right way, how to find the best contractors and manage the best contractors, and what tools and processes you should be doing to make your rehabs less chaotic, more repeatable, more smooth, more on time, and more on budget. So if you're interested in that, I'd love you to go check that out. I poured my heart and my brain into that course, and I know it will provide you guys value. Now, other huge learning lessons with this property was that you need to have enough cash flow to support repairs and other things that come up with the property. And so my rule of thumb before was always, hey, I gotta have $500 of cash flow per each property. So if anything happens, like a washer, not anything, but the majority of things happen. A washer goes bad and I have to replace a washer, I have to replace a refrigerator. Pretty much it is don't make any money that month. But I'm not pulling money out of my bank account. And that always has worked really well for me. And so I think it's very hard to find $500 cash flow a month these days because of how much values have gone up, how much rents have gone up, and expenses have gone up. But I do say that that is super important, that you need to have a margin of safety. I would say no less than $300 per month in cash flow. If you have less than that, you're gonna be pulling out of your own bank account some months, and that gets stressful. The other huge takeaway is knowing your location, knowing if it's growing. It doesn't have to be amazingly picture perfect. It can be on the fringe, but knowing what stuff your tenants like. So this property is right near a beautiful Wegmans shopping center that I always loved. We actually lived a couple blocks away from this property. That was one of the reasons why it was such an amazing investment property. I could just walk out my front door and I'd be over at this property in 10 minutes. But you want to know what your tenants like. If you know what your tenants like and you purchase near what your tenants like, they're going to stay for a long period of time. So we're talking about the grocery stores. We're talking about shopping, entertainment. You want to try to get around those like Starbucks or coffee shops or things that people really want. If they are way far away, then it's going to be a little bit harder to keep those tenants. Your tenants are going to want the same things that you want. And so I have found that rule of thumb to be super helpful for us and allows you the highest chances of success when investing in rental properties. All right, so let's get down to the final numbers and how we came up with that $265,000 in profit for one property. So we're gonna go over all the numbers here. So I averaged it out to about $6,500 per year from cash flow from rent. So over 10 years, it was about $65,000. We spent about $10,000 on renovating the property to get the property rent ready. You can see the listing right here. We'll scroll through all the pictures. And so you can see we painted the property, we added flooring, including LVP in the basement and carpet in the upstairs, and just did some touch-ups. We actually kept the majority of stuff in this property as it was in good shape. That included the kitchen cabinets, that included the bathroom vanities, that included the tile that we did in the bathroom. They were all still in good shape, so we were able to keep it and not have to renovate it again, which was huge. And so you can see the video walkthrough as we kind of walk through the property, and this was done for the listing, so you can see all the renovations we did and how we kind of staged the property. And so I also want to talk about the loan. So we had a loan for $170,000, but when we went to sell the property, that loan was $160,000. And why was that? This is what's called principal pay down. So as you have a loan for your investment properties, the longer you hold your investment properties, the more you pay off that loan and the more aggressive you're pay off that loan because you have a lower principal. And so with the refinance, it was somewhere around like 174, but when we went to sell the property, it was down in the 160s. And so again, the longer time you have your investment property, the lower the mortgage balance is going to go, the more money or profit you're going to make when you sell the property. So again, longer time, bigger profit in the end. So we sold this property. You can see here, we sold it on 9/16/2024. We sold it for $385,000. So we had the $160,000 that we owed on the loan. We had the $10,000 in repairs, so $170,000. And then we had $15,000 in real estate commissions that we ended up having to pay in taxes and fees. And so that came out to a profit of about $200,000 on just this one property. And then if we take the $200,000 that we made just from the sale and we add in the $65,000 of cash flows from rents every single month that we made on that property over the past 10, 11 years, you get $265,000 in profit for just one property. Again, we didn't even go into the tax benefits, so property depreciation, so mortgage interest deduction. So even though that is the profit, over the lifespan of owning that, it's actually higher because you get all these benefits of owning real estate. So thanks for watching the video. We have other videos where we discuss how much money we made on the individual properties, whether it's from cash flow, whether it's from sale. I call the playlist Investing by the Numbers. I love the playlist. There's a bunch of videos there so you can see how much we make on each one of our rental properties. We'll see you there.